All right, let's get this party started, ladies and gents. Welcome to the webinar roll up and jump in and jump in. I will have a little look at the markets on my other screen while everyone's getting in and getting settled. We've got a pretty heavy day in the NASDAQ. That's probably getting hit the worst. Looking at my screen over here. Russell a little bit worse. S&P down nearly a full 100 there. Dow sniffing at the 500, minus 500. DAX, yeah, closed pretty weak. Yes, a perfect time to be doing this webinar, right? What else we got across the board? Do you know what, as well? It's only 6 o'clock UK time, so we've still got plenty more trading hours. First day of the month, technically trading day, full trading day. Ominous. However, listen, we've got elections coming up. We've got a lot of good stuff coming up. We'll see what happens. We'll see what happens. There's a lot of potential fuels to the fire. We've got non-farm on Friday as well, which should add some spice or potentially add some spice. Nvidia taking a bit of a battering as well today, down 7% or so. It's a tech stock rout, isn't it? Down 6%, AMD 6%, Apple 2 and a bit. Crude getting hit heavy. All right, we'll get started in a minute or so, ladies and gents. Just get yourself comfortable, get yourself a drink. I'm sure you've got one eye on the market, maybe got a position on. I accept that. You know what I mean? You're a trader. You may well have a position, or maybe done for the day. Maybe like, you know what, I'm done for the day. I'm going to focus. I'm going to try and learn something from today, the webinar, and take some notes and hopefully take away some nuggets. Whichever camp you're in, you're very welcome here. We shall get started in about 40 seconds or so. Let's get started at 6 o'clock on the dot. Do it all properly. And we will kind of have a little chat about what we're going to cover today, some things maybe we're going to cover in the future, and kind of explain how it all works if you're new here or if you're not. Very welcome. You're welcome back anyway. So yeah, deep red day today. Let's see where it closes. It doesn't look good at the moment. We haven't had much of a bounce, have we? We have not had much of a bounce. But you know what? Sometimes the market will overstretch itself too far too soon, kind of runs out of sellers, and then kind of oscillates back to VWAP. I'm always more cautious with the market that tries a bounce with about 45 minutes to go, tries that, struggles, maybe puts in a pin bar to the high side, and then rolls over kind of with 30 minutes, 15 minutes to go. That tends to add a bit more urgency to things. It's when it's really hammering to lows without a bounce early on, you can sometimes go, oh, you know, what's going to happen there? But we'll see. We'll see. It's not a webinar about the current trading day. It's about volatility in general. So welcome. Let's get started. 6 o'clock, you're very welcome here. Okay, so understanding volatility we're talking about today, trading strategy selection, along with some other bits and pieces. A little bit of housekeeping first, if I may. A great quote from Paul Tudor Jones, one of the greatest traders alive. The most important rule of trading is to play great defense, not great offense. Everyone gets worried about strategy, but it's actually far more important to stay in the game, and that is such an apt quote from the man himself, PTJ, when we're talking about volatility, which we're going to talk about today, because it really is a game of risk management and then pressing the throttle only when you've kind of done the hard part, managed the risk, traded in the cruise a little bit, you've got your foot on its neck, so to speak, and you know things are working out. So before we get kind of stuck into stuff, I just want to remind you guys, if you're trading with a spread bet or CFD product, then there's a high risk of you losing money because of the double-edged sword of leverage, right? It works very, very well when it's working in your favor because obviously a short move to the upside. If you leverage right up, you're going to get much more back. But on the downside, you're going to lose money quickly as well. And it can get out of hand quickly, which is why risk management is so important. And I bang the drum about that, and you've heard me many, many times before. We'll cover a little bit of risk management today, especially in high volatile environments. But please just understand the product you're trading. If you're brand new to trading, double check you know what you're getting into, you understand how the platform works, how margin works, how leverage works, all that other good stuff. And if you do, you understand that, then let's go. Let's try and talk about some things that can help improve your trading. Okay, so today, quick reminder. My name is Mark Holstead. Those of you who have been here before, welcome back. Those of you who are new here, we kind of do these webinars, and we're lucky enough to be able to do these once a week now. So Pepperstone, partnership up with Pepperstone here. We're going to do once a week through to September, October, November, taking you into the election. Got some election content as well for the webinars. Loads of stuff I want to cover. Loads of great topics that I want to share with you. To really help you improve your trading. Now, listen, I have experience in the markets. I've got 22, 3, almost 4 years experience trading, but I don't have all the answers. Even with that experience and with what I've done in the markets, I don't have all the answers, but I'll try and share with you key ideas and thoughts that I think will help you in your trading, and also quite well placed, really, because running Traders Mastermind, with a group of a community of traders, I've seen traders come in who are, it wouldn't mind me saying they weren't pretty awful, and they're kind of now putting profitable year in next profitable year. So I kind of get to see different personalities, different trading types, and observe what's worked for them. So with my own experience and seeing others kind of moving up, if you like, I think I'm quite well placed to help you out. But I don't have all the answers, absolutely not. But I'll definitely try and help you where I can, by sharing those experiences, sharing my observations. And if I can't help you more than that, I'll probably know somebody or somewhere or some website or some tool that will help you get to where you want to go. That's just the way it is when you've been in the business for a long period of time. Okay. And one thing to mention is, please do your own analysis, your research, homework. Of course, it goes without saying. Don't listen to some dude on the internet. And things take time, right? If you're going to make a change, implement a change, and I often say this in the webinars, things do take time. And so I don't know exactly what it's like, right? You go on a webinar, you get all fired up, or you learn something and you go, I'm going to do this. And then you kind of do it, doesn't work. And you go, oh, I really like that idea. And then you go to the next thing and next thing and next thing. The key really is to say, discard the stuff that is not really relevant to you and you don't really like, and that's fine. Grab the things that resonate with you and say, I like what that guy says there. I like what this lady says. So I'm going to use that. Implement a change in your trading after you've kind of done your own analysis research, and then stick to it for a bit. And sticking to it and then adjusting, observing the results and making the course correction. So example would be, hey, I'm going to change the way I manage my risk. Okay, we'll do that, but plan to do that for a period of time and then review the results rather than just seeing how it works for 1 day or 2 days. It's like holding trades, right? We've all been in a situation where I'm going to hold a trade today, and that day is the day that the market goes all the way up and comes back and doesn't hit your target. The next day you go, I'm going to take an A to B scalp trade. You do that, the market rips off. It's sticking to some sort of process and then observing the results, make a course correction, next leg, next leg, next leg. Anyway, going off on a tangent. Today we're talking about volatility. Set up some strategies for volatile conditions. A little summary of what we're going to cover today. Set up some strategies for volatile conditions, some risk management tweaks, ways we can adjust and manage risk, a performance review process, mindset adjustments, which I think are super, super important, and trapdoors to avoid. I call trapdoors to avoid. And I see traders just stepping into these trapdoors that are a little high volatility. So always waving at you and just beckoning you over. High volatility, come on over, you come, and you don't see that trap door lying right there, wide open. You step on it. So I'm going to cover some of those trap doors that I think are pretty common, and we can avoid those. Okay, so today I've arranged for you some high volatility. Now, how's that? We've got some spice in the markets. So what a great day to be talking about high volatility. And the reason I wanted to cover this, and the way I generally work is this, is, I say to Pepperstone, hey, these are topics I'd like to cover. I think this is going to be very useful for this type of trader. Can I cover this? Can I do this? Can I do that? And we kind of work it out with what they want to have out there, and all that other stuff, and what they think is going to be valuable to your clients. If you're a client of Pepperstone, if you're not a client of Pepperstone, then they hope that you'll check them out, look on the website and see if it's right for you, look at the spreads and that type of stuff. And this is kind of this partnership we've got. I'm sharing things that I think are going to help you. And I think, with the I thought summer might be quiet. How wrong was I? And I actually happened to have a holiday in the most volatile day, which is typical, but you got to book a holiday at some point. Anyway, back in the thick of things, looking forward to getting stuck in September, October, November, December. Really excited, actually. Really, really excited. So this is why I wanted to do this, because we've had high volatility beginning of August, right? So we had that kind of sell-off with the old Japan scenario, pop back up. And even the last week or so has been reasonably quiet. Today's spicy. We've got lots of fuel coming up to add to the volatility fire. We have non-farm payrolls. We have election posturing, all sorts of stuff going on. So I think it's a great time to be a trader. September, October, November, first couple of weeks of December. it's going to be beautiful conditions. I really think it is. And so, this webinar, other webinars as well, going to hopefully help you really kind of package that in your mind and think about the best strategies to deploy, and all the stuff that's going to. Well, my real hope for you is that you kind of come to these webinars, learn loads, improve your trading, and you can get momentum into the new year. I know I'm not talking about new year yet. I am, but I kind of not. Get the momentum so that when you start January, you've kind of got, yeah, you know what, I can look back and go, yeah, I feel good about my trading. I'm not sitting there looking at the Big Bang's bonging away at midnight going, oh, trading wasn't that great that year. It's the time to put the work in now, just trying to get some momentum and trying to get some numbers on the board, so to speak. Okay, so enough of that. Let's stay focused. What we're going to cover today is that. So the first thing I think is super, super important, is to reframe volatility in your mind. And what do I mean by this? So we've all been guilty of this, and I see other traders doing this. I remember myself, a couple of decades ago, doing exactly the same type of thing and treating volatility like this. When the markets are spicy and active, we think to ourselves, "Oh, the markets are moving. There's action. I'm a trader, right? I should be killing it in the spicy market conditions because volatility is my lifeblood, right? I like volatility." And you've got to be a little bit careful that you don't just look at volatility and say to yourself, the market is moving, I should be getting involved. And then coming to the screen, seeing action, your mind's already calibrated to kind of normal conditions, so to speak. You see the extreme conditions, you see the fast markets, and you see an opportunity, you jump in. You get stopped. Before you know it, you can hit a daily loss limit, or you can do some damage to your account. We don't want to do that. Volatility does not always equal profit. Volatility does, however, equal more opportunity. There are two distinct ways to look at it. And I think reframing volatility in your mind by saying, hey, be very, very careful here. The market's moving. It's moving quick. It can stop me out very quickly. Things can get nasty very quickly from the wrong side of things. If I'm not careful about risk management, I think we all can own up and say, hey, at some point in our trading career, we've been in a situation where we've added to a position we probably shouldn't have. We've been stuck in a position we said we're going to get stopped out on, and we've just prayed to the market gods that sucker's going to come back and we will never, ever do it again. We don't want to be in that position. And as a developing trader, it's an easy trap to fall into. The good news is, as you become more experienced, then you put your hand in that fire so many times in the early days, it's just not going to happen. You just say, hey, you know what? This does offer me a lot of opportunity, but it doesn't guarantee I'm going to put green in my account. It's there. The opportunity is good. So that's the way to reframe it, I believe, is the more powerful way to do it, is to treat the volatility with respect, embrace it, look forward to it. I'll show you in a minute how we can tame it a little bit with size and the different things if you need to. But I think that just being careful that you don't dive into stuff, because the opportunities are great when there's a high volatile environment, because you do get stretched markets. The spring is really kind of stretched. You can catch those reversals back. We'll talk about those in a moment. You can catch like really aggressive momentum that continues way further than you expect because of the increased volatility. So the opportunities are definitely there, but be very careful about that FOMO mindset of it's moving, I've got to get in. If you just take your time, calm things down, take a step back, there's going to be opportunity. There's going to be another setup. There's going to be things happening. And I think that is a good starting point. Reframe it in your mind rather than get excited and kind of punting away at it. It's like, hey, there's opportunity. Levels are going to be hit. Levels are going to be broken. We're going to have the things that I need to see to be able to create some good trading opportunities. Okay, so let me talk about trapdoors. So you know what I mean by trapdoor, right? You're walking along, and you don't see that trap door, which is a door in the floor, basically, that is there to trap you. And the idea being that you don't see it coming. And I want you to be aware of these. I want you to kind of go in. You see volatility kind of in the distance. You like it. You want to move towards it. You're like, I like that volatility. I'm coming to volatility. But you're aware that actually on the way, you do have those trapdoors, and to be very, very careful of them. So the first one is not adjusting size accordingly. We'll talk about that in a moment in one of the slides, but that's the real key to taming volatility, is to adjust your size accordingly. Now, I will say I appreciate there's going to be different traders from different levels here. Maybe you are relatively new to trading. Maybe you're very, very experienced in trading. And sometimes if you've got a lot of experience in the markets, volatility is a time to maybe put the pedal down a little bit, but with an understanding of the risk that comes with that, right? You earn the right, if you like, to trade a little bit heavier. You accept the risk that comes with trading a little bit heavier. You say, fine, I accept that, but the conditions are aligned with my edge. I feel like I've got a good opportunity here. I'm going to trade a different size, or I'm going to trade a little bit more aggressively. And that's fine. You've got experience and results and discipline to back that up. But if you're kind of a developing trader and maybe kind of it's a second period of volatility, or maybe it's a little bit unusual to you, and you can still trade volatility. By the way, I should add, if you want to not trade, that is fine. Stepping back and just observing and learning when the markets are really, really spicy, that's good. That's good too. You better become a specialist in normal conditions than a specialist in really high volatile environments, right? Because they don't come around very often. But you can tame high volatility with size. Number two is wasting bullets on poor opportunities. So a little bit aligned with the last slide of FOMO. You come in, you see the market conditions, you go, whoa, you see a chart that's going lower, bang, and you're short. Next thing is it pops up. You're like, geez, I didn't realize it was pop up so quick. All right, better take a stop on that. You see it again, you're like, run with it. And before you know it, your initial reaction to the chart has planted a seed. Then now all the trades are coming from that, and you haven't kind of stepped back, given yourself time to rely on your screen time and experience to develop a new strategy, a new idea, a new setup based on what you see in front of you. Like coming into the market now, seeing it down, going, I'm going to go short. Now that may well work, but would you plan and say, well, am I better off shorting on a pop? Do I want to wait for a flush to the downside to get a long exhaustion move? Is that going to be better for me than just kind of seeing something and impulsively going in? So be very careful about wasting your bullets on poor opportunities. And bullets, I mean, maybe you don't have a trade number restriction intraday. A lot of people do, a lot of people don't. That's fine. It's personal preference. I mean, like by that, I say, I'm going to take 3 trades today, or 5 trades today, or 2, whatever it might be. But you should all have, or we should all have, put myself into that, a daily loss limit where you pull yourself away from the screens, right? So every time you lose a little bit, you're chipping away at that daily loss limit. And it makes no sense to kind of waste those bullets on poor opportunities, because the beauty of volatility is it creates opportunity. You should think volatility is opportunity. Okay, and the third trap, which ironically is one that catches so many people out, especially if you're reasonably experienced, right? Brand new traders find volatility is like, oh, geez, things are moving wild. I'm getting pinged out here left, right, and center. I feel like I've done 12 rounds with Mike Tyson in his heyday. Not going to feel great. But as you become more experienced, the trap that I see many traders falling into is the assuming that high volatility will continue. So what does that mean? That means that if you've been doing very well trading momentum, and we're going to talk about momentum and strategy in a moment, ironically, but if you kind of done well trading momentum, then the volatility gets crushed. You are there buying at highs thinking, man, high vol has been working very, very well. I've been trading this magnet type trade, trading momentum ignition. Beautiful. Let's go again. And the volatility just gets crushed, which it does. It doesn't stay high for long. You're still trading that. You end up giving back a lot of the profit. So that's a trap that I see a lot of traders falling into. And if I'm honest, it's a trap that I'm very, very aware of myself. It's, if I look back over my years, I've probably given more back than I should by pressing too hard, assuming volatility, supposing volatility, or whatever it is, and actually, being much more aware and saying, hey, listen, high volatility is there. Great, take advantage of it while it's there. But it's never there forever. If the momentum starts to wane, and things start to peel back a little bit, then take your foot off the throttle. It's fine. You can always put it back on. And yeah, you might miss a couple while you recalibrate, but that's okay. So assuming high volatility will continue is the third trap in the trap door. Okay, so let's talk about taming volatility. We'll get some setups, I think, in the next slide or two. But first of all, I want to kind of be clear on how we can really, tame volatility. The easiest way to do it, ladies and gents, is just to reduce the size to accommodate the wider ranges, and just be mindful of news flow. So high volume of volatility, should I say, often comes from news. And so if you've got your finger on the pulse with the news, like we had in sort of 5th of August, 6th of August time, we knew what was coming out of Japan. We knew that it was all sorts of, the trade unwind, the end trade unwind. It was all that type of stuff. You're watching the news flow with there, just like if you're trading in the global financial crisis, if you're trading during all these periods of time we've had, even when they were chasing bin Laden all those years ago, the news would come, oh, they've caught bin Laden, market would spike. Just be aware of what the news flow is. You don't have to be slave to the news, but just be mindful of the news flow, and force yourself screen breaks. Honestly, because it's so volatile and you're sitting in front of the screen, it's very easy to get burnt out. And it's your duty to preserve that energy and that focus for those really juicy opportunities. If you're wasting it on sitting there watching tape when the market's been stuck in a multi-hour range, it's pointless. It's pointless. You've got finite resources. You may not think it, right? You've got finite resources. We all think we're superhuman, right? We're traders. We think we're geniuses, extra special superhumans who can sit in front of the screens for ages. And maybe you can, but at some point, your performance will degenerate. It will decline. And so force yourself having to have screen breaks. But let's go back to point one here, reducing size to accommodate the wider ranges. This is more of an operational, tactical way to kind of tame volatility. Very, very simple, right? But I want to cover it because maybe, a reminder and just kind of looking at volatility through a different lens. So if we go back to a kind of standard Japanese yen chart, right? USD JPY, a 50-minute chart. And I'm going to show you what I've got on here. I've basically got volume and a moving average on volume on the top, and I've got a 1-period ADR. So it's the range of that candle, and I have a 10-period. I think it's 10 period moving average on that. So it's the average. Actually, it's not a moving average, which would be exactly the same. It's a 10-period ADR. So you can use ATR, can use ADR. I'm going to show you how to do that in a second. But basically, let me summarize this. It's giving me the range of the candle. And the red line here is kind of the average range of the last 10 candles. So I'm getting a good feel for, what the range is like, whether a candle stands out as being a really aggressive candle. Does it line up with the open of the cash session, US session? Does it line up with, European close? Does it line up with when the Hang Seng is doing something, that sort of thing. So we can see here we're running at 20 pips, so 15 minutes period, we've got about 20 pip movement. So it's pretty standard market, not bad, pretty decent compared to what we have had, but not bad. Okay, now if I move to this, for example, I'll go back to that slide in a second, 50-minute chart, during that real spicy time, 5th of August, we were running at 80, 60, so massive amounts different, okay? So the chart may be similar-ish, right? It's come off highs, it's going lower, look at this, one here, it's come off highs, going lower, but the order of magnitude is way, way bigger. Volatility has spiked. It was peak, all the nonsense that was going on, right? Fine, but we can tame this by knowing what the average range is and positioning accordingly. So I just picked like a pretty standard sort of bear flag entry that you may well have taken here. 100% hindsight, 100% to illustrate the position. Not suggesting that this is something you would definitely have done, but just illustrate something that you might reasonably have done, right? If you were sitting on the short side here or looking for a short, a standard break of a little kind of bear flag, textbook stuff, right? And normally you'd put your stop above the high of that flag. And so in this scenario, when the market was running at about, 20 pips, maybe 40 pips on a push, every 15-minute candle was 40 pips, you might have a 20 pip stop, right? That's a pretty reasonable stop. Maybe you could argue with me, have it a bit more, and I'd agree with you, fine. We're not looking at the intricacies of the stop placement here, but if you were running a classic 3-to-1 risk-reward ratio trading strategy, not looking to be smart on a target for whatever reason, just looking for 3-to-1, this is how you structure it. It's a 20-point risk. You got a 60-point target, and this would have done okay, fine. But if you did that same type of thing, and let's say, well, you should use a similar thing, but let's say you traded the break of this high, right? When it's highly volatile, all of a sudden now a standard kind of normal chart, I'm not kind of taking these to extremes, you're almost looking at 130 pips. Yeah, and a 3-to-1, or just say with 3-to-1, that's like a 400 pip move. And so you might be like, okay, well, what does that mean? Well, that's okay, but you just have to adjust your position size to accommodate. Stops should be determined by the structure of price in front of you, not where you want it. If you put a 20 pip stop in this, where you had been using a 20 pip stop before, in here now, it's just going to literally sniff in your direction. You're going to be stopped out. So you have to accept that you're going to have to use wider stops, but you can accommodate those wider stops by just decreasing the size. Okay, so stop distance is price-based, and that's another topic completely. Let's assume you're placing it under some structure, under a prior low, or if it's momentum, under a prior bar close, prior bar low as well, or under a daily low, all this type of stuff. You kind of probably know the score. You're going to have that start, and even if it's a percentage of ADR, right, it's going to be there based on price. But risk is set by you. So if you're risking, say, £200 per trade, let's say, you just adjust the size to accommodate the stop. So in chart one, that I'm not going to go back to it, the 20 pips stop, your size would be £10 a point, you're risking 200 points, £200, sorry, 20 pips. Now, if you go to 125 pips, your size is going to have to reduce massively to accommodate that. So you can tame volatility with size. So it's up to you. You just have to think of it in terms of, hey, how much am I prepared to risk per trade? How much am I prepared to risk per day? What's my max circuit breaker, drawdown on equity curve, all those other good stuff. And that's maybe digging into another rabbit hole of risk management, but important to note that as we go through with some of these strategies and stuff, you can trade small size or even more if you're not comfortable with trading even this. You can say, and you saying, hey, you know what? Maybe I'm allowed to risk myself £600 a day, normally 3 trades, but there's going to be a lot of opportunities today. I might even halve that and say, you might even halve that and say, hey, I only will risk £100 a day or £1,000 per trade or £100 a trade, whatever you're £10, doesn't matter. The order of magnitude is irrelevant, but you can adjust the volatility, with size. So you can still enjoy the opportunity that volatility presents without being kind of worried you're going to get wiped out. And a final kind of point here on this before we move on is, if you try to trade the wide ranges with tight stops, you're just going to die 1,000 cuts. I know we kind of think that we've got a read on this and that on the other, and then maybe there's the odd setup and strategy where you can have a tight stop. I agree. There's some momentum trades you can trade with a tight stop. I don't disagree with that. However, generally speaking, the noise that's going on when there's high volatility, algorithms are in full force, the market making algos are smashing away, the arbitrage algos that are arbitraging the futures contracts with the basket of stocks. And if you're trading a CFD, that's going to be mirrored onto that. It's just going wild. So you've got to accept there's a lot of noise in the market, and you're not there to trade noise. You're there to trade moves from A to B, trending moves, reversals, those broader things, even if they are over a few minutes or a few hours, but we just don't want to get cuts to death by tight stops. It's just frustrating. It's annoying, right? And it's almost a little bit naive to think that we can time it with that level of precision all the time. You might get away a few times, but the general rule of thumb is just be a little bit wider with your stops. You can always tighten them up when things start going in your favor. You can always peel on a bit more size when you've got a bit of risk off the table. There's plenty of ways to manage the trade. It just gets frustrating because it's paying all the time. It's a final thing on this. It's easy to go into kind of a tilt mode. And I mean by tilt mode is, well, you know what tilt mode is, I guess, but let me explain. You take the trade, you get stopped out. You take another trade, you get stopped out. And now you're really, really annoyed. And so you take another trade, like, I'm going to get this break, get stopped out. And then the market goes in your favor. You're like, God damn it. Right, I'm going to fade it. And then you start running from an emotional perspective. You've got an emotional driven order flow, emotional driven trade, should I say, rather than logically driven trades. Dangerous game to play, ladies and gents. Dangerous game to play. That's when blow-ups occur. So just be careful about a death by 1,000 cuts. Excuse me. Knocked myself out of the lemon. Should have filled that up properly before I started. Okay. So we've got about 30 minutes to go. Great. Going to run through this, and then we're going to have some time for some Q&A. Okay, before we get to these strategies, and I think you'll like these strategies, just remember this. Please remember this, actually. I please on stuff that I really think is valuable. Just remember that you're a risk manager first and foremost, right? That's your job. And as Paul Schroeder Jones was saying, you have to play defense. You have to play defense. Your job is to protect capital and then grow it when you see the opportunity. And so you protect the capital with those stops, with risk management, with smaller size when it dictates it. And then when you feel like pushing the throttle down, you see like, hey, I think I've got a good opportunity here. I'm prepared to take the risk. I understand the pros and cons of using this leverage. Okay, I'm a big boy or a big girl. Here we go. I'm going to go for it. Opportunities are plentiful. Missed trades are normal, and all about building that confidence, right? I know people can be a little bit lack confidence, and this is perhaps another big topic to cover at some point as well in trading. It's chicken and egg. You haven't got any results to be confident about when you're developing trader, but you need the confidence to kind of get the results. So what the hell am I going to do? And we'll perhaps cover that in more depth, but just think that this, you're a risk manager first. If your process is sound, if you're managing risk effectively, you're doing better than most people. Opportunities are plentiful. Missed trades are normal. I want you to think this. When you see trades and you don't take them and you miss them, rather than going, missed that, I would have made X, go good. I would rather miss trades at the benefit of missing all the substandard trades and miss some good trades. I'd rather miss some good trades and miss a load of substandard crap trades than I would take every single good trade and actually have some of the rubbish trades bleed into my performance. If you think about where like a scale, right? Here's like I just take very, very few trades. Here I take every single trade that's going. You want to be just on the side where you're missing more trades, because that way you're not having the pollution of the poor trades in your P&L. Sure, you're gonna have losers, right? A good trade doesn't mean it's a winning trade all the time, but you know what it's like. Sometimes you look back and go, why I'm giving back all that profit trading absolute dog, you know what, absolute rubbish, chop and slop. And you want to avoid that and have a mind of, okay, I avoided all that nonsense. And okay, maybe I missed out a little bit of, a few of the good trades as well. But that's okay, because I'd rather do that than be the other way around. That makes sense. You really want to be missing trades than taking too many. And how you frame that volatility in your mind is so important. Okay, so let's talk a little bit now about trading strategies. So really, when I talk about strategies, my objective with these is to share kind of a foundational approach to stuff. Now, sometimes I guess we have done stuff where we've covered kind of a definite trigger and a kind of filter and trigger process. And hey, this does this, and this is worth looking at. Like the opening range breakout is very specific, and there's you can kind of adjust it a little bit, but it's kind of pretty set in stone. But my real objective with these is not, hey, go and trade these straight away. These are amazing. Woohoo! It's like, okay, listen, this is the cornerstones, I believe, of this type of market regime. So when you're trading volatility, it's a very different lens you've got to put on than when you're trading a kind of quiet range bound environment, right? And so my perspective of things, and also I've seen others kind of use this and work for them, is you've got two ways of looking at volatility. You've got exhaustion, which are kind of reversals, so market moving one direction and just running out of sellers or running out of buyers. You observing that on your chart and you trading it for a reversal back. That's my preferred one, if I'm honest, from a personal perspective. A momentum magnet, which is we identify a target that we're working towards, and we work back and reverse engineer the trade that's going to set up to help us get there. So you can see these are really, when you're trading on normal conditions, you've got mean reversion, you've got trending, right, or momentum, wherever you want to put it. You either go with the market, so you're going, hey, I want it to continue, or you're going against it. You really can't do much else unless you're going into different kind of really bizarre strategy, not bizarre strategies, perfectly normal, like pair trading strategies or whatever, but you're still trading ultimately. I want this market to continue and trend. I want it to mean revert. But for volatility perspective, which is adding a little subtle distinction on this, changing the recipe slightly, exhaustion, because we see that in high volatility environments. We don't always see exhaustion under normal market conditions. And momentum magnet, which is where we have that magnet. And I'm going to show you some examples in a moment, hope it make it a bit clearer. And then we're kind of layering in momentum strategies and setups and kind of signals, if you like, with that magnet to create those kind of two distinct different paths. All right. So, again, we'll cover these, and my objective is to make you think about, okay, so if I'm just focused on that, where's going to be my grade A opportunity? The next time we have a really nice volatile environment, okay, I can look for this. And okay, let me even back up even more. So we go back to the FOMO slide. I won't put it on. Back to the FOMO slide. Where very often traders come in, you see something, I'm going to go short, I'm going to go long. Now, hopefully, by the end of this kind of next 20 minutes or so, you'll be able to say to yourself, right, do I wait for the selling to continue and try to spot a reversal using these kind of this framework, or do I pick a magnet out, which will go through, and I want to jump on momentum? Just that thought process alone will stop you just diving in and just playing it and going, oh, I don't know what to do, I don't know what to do, don't know what to say. Okay, so just being mindful, about that, really, really mindful. Okay, so exhaustion signals are magnified in high volatility environments. Honestly, I have to confess, this is one of my favorite setups. This has been very kind to me trading this type of way. It doesn't happen very often. We don't get it all the time, every day. And some people say, oh, we can trade exhaustion on lower time frames. Yeah, sure. Okay, sure. Perhaps we'll cover that at some other point. There are different levels to exhaustion. But if you think about exhaustion, by the way, what I mean by this is capitulation. What's another word for it? I always like to use exhaustion, but a real kind of crescendo of buying, the last of the selling. You've seen it on a chart. You kind of know what this is. And really what happens is if we look under the hood, that's an unauthorized Americanism. If we look under the bonnet, we can see that, what's happening at hash is selling, 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 selling. And very often it's just a final market sell order or a final flurry of sell orders that sweep the bids. You get a very large range bar. You get a lot of volume coming in, and that tends to mark the end of a move. Now, it's not always the end of a trend, but the end of a short-term move, enough for you and I as short-term traders get to capitalize on a potential mean reversion back up to kind of some kind of mean. That might not be that far, but there's opportunity there. On the buy side, the same type of thing. You tend to not get it on the upside as often because there's no rush to buy. Sometimes there is short covering. There are kind of some scenarios, maybe you've gapped down, maybe it's the end of the month. There are times when you do get this exhaustion, but generally speaking, people are more scared of losing money to the downside because most people are long, blah, blah, blah. You get the idea. And then magnified in the high volatile environments because every single participant, well, not every participant, but a lot of participants are involved. Higher time frame money, institutions are playing around with it, algos are playing, retail traders playing. All the participants are watching and getting involved. So exhaustion, think of these three things: bar length, bar volume, distance of move prior. Is that good English? Yeah, it's fine for a trader, right? So setting this up, use ADR and volume. If you use TradingView, you can use ADR, which is average daily range. And it sounds, well, I'm trading intraday, Mark. Why am I using average daily range? Well, 5-minute chart, if you set ADR, it's just the range of the candle. ATR does the same. The only problem with ATR is it takes into account gaps rather than literally high and low formula. Very super simple. I like to plot this on a histogram below, and I like to have an ADR of a 10 period next to it so I can see where we're in relation. And just literally eyeballing that, look where the two big reversal points are, where we've had a really, really big range bar. Now, I do put volume on as well, but the more I see the range, the more I kind of go, you know what, most of the time the big range comes with big volume. I have it on my chart. I've got it there now. But this is the beauty, right? I think this is the real gem. And if you're trading high volatile environments, maybe you don't have this on all the time. I personally do. This is kind of my go-to. But you can bring it on, have a kind of separate screen setup that you go, yeah, you know what? I'm going to kind of load this in. It's a high volatile environment. I'm going to load in my ADR. So try it out. ATR, ADR, set ATR to 1. So you just want the 1 period, and that's going to, and personally, again, I'm not going to say, oh, you must have a histogram. It must be that exact shade of blue, otherwise you'll lose. And, I like to see this because I like to see visually how different it is, how different it is. And I just like that histogram kind of format. So really good way to display exhaustion, both sides of the coin. Now, this was AD, JPY on that real heavy day. Big exhaustion on the 5-minute bar. Happened to flag the bottom. Yes, I'm putting this up in hindsight. I'm just showing you the kind of what you to look for. And we'll show you in a minute how you can kind of use this. But that's how I set it up. ADR, 1 period, 10 period, and that gives me on TradingView this type of look. And I just like that. It's personal preference, but hey, I thought I'd share it with you. You can either like it or not. So if we look on the same day and the same setup here, the same chart setup, we've got these high spikes. And these high spikes are showing us the range of the bar was pretty big, right? Now, when we've got that big range, we are potentially thinking that's exhaustion. Now, I want to also iterate that the move prior, in other words, what's happened before price moved, is so key. Because this is a great question someone asked the other day. They said, well, if I get a big range bar, what's the difference between exhaustion and momentum ignition? The difference is the context. So if we've had selling, really sped up, and then we see a big spike, a massive volume bar or a massive range bar, that's more likely to be exhaustion than just coming out of a range and then we see a big range bar. That's more likely to be a momentum ignition. Leave that topic for another day. Let's focus on exhaustion. So you probably could have reasonably expected this one to be the low or the exhaustion bar. Yeah, and I would have said, I don't disagree with you. And if you're not careful with hindsight, you go, I never would have taken that. But it's come down quite a lot. It's pretty heavy. It's got a decent move. It's kind of accelerated a lot here. You get a decent pin bar. You get a decent kind of big fat range bar. You probably would have bought there. You could have easily bought there and taken a stop. Fine, that's the way it is. What about here? Would you have bought there? Well, you may have done. Now, the key thing is with this is it a holy grail? Absolutely not, right? But I want to show you, rather than just ignoring these things and saying, "Oh, you wouldn't have taken that," just to kind of highlight areas where you would consider doing business. Now, if maybe you saw that and go, "Hey, it's quite early in the morning. Do I really want to be taking that? Do I want to wait a little bit until kind of Europe starts to at least wake up?" Maybe you do. That's context. That's stuff that you kind of add into the system, if you like, to help you kind of really pinpoint stuff. This was the biggest range bar of the day. That was the low of the day. The biggest range bar again was here, and that was the low of the day. Now, this may well not have been the trade you wanted to take, right? You may well have said, okay, I'm going to wait. I'm going to wait for a retest, and I'm going to take it here. And okay, we've got hindsight here. I understand. I respect that. But if you are adding in skills and price action that you already have, in your trading, you can then say, right, I'm going to wait until we retest a level. I'm going to wait until we break through support and bounce back up. But I'm going to layer into it a wide range bar. And a wide range bar may well help you get a really, really good trade on. So look for a wide range bar, look for the context. Okay, talking about context, by the way, I wanted to quickly mention this. Look at this on AUD JPY. The key to the exhaustion trade, or to lining up with exhaustion, or at least using exhaustion. And by the way, I've not added any triggers in here. I've just said, hey, a good way of not getting FOMO, not getting caught and stuff, to say, at least wait for a really, really big range bar. At least wait for selling to have been persistent. So you're looking here, hey, 7.5 hours, didn't move much. Now in this 1 hour 50, we've moved 3.5%. Whoa, that's really significant. Okay, now look for the wide range bar. So not straight away, look for the persistency of trend, look for the acceleration of the trend, then look for because you can sit on your hands. You can just say, no, I'm going to touch it until I see a big fat bar to the downside that's just way, way bigger than others. Then I might consider it. Now, do you want to wait for it to pop back up? Do you want to trade a kind of break above the high? Or do you want to take it on the close? Whatever, that's up to you. But this just helps you tame volatility a bit and at least sit on your hands until the opportunity is a bit more, likely to play out. So if you go back to this, right, you say, okay, we've rolled over. It's in quite a while to get to here, but look at the kind of speed of this move, bang, and then you get that massive exhaustion bar. That could be an indication that it's exhausted itself. Sellers are done. We're looking to roll over. So something to consider is, and the way that you can kind of go back and test it for yourself is to really say to yourself, okay, let me put that on my chart. Let me go back to the markets I trade. Let me see, just with a kind of really open mind, how often big range bars coincide with swing highs and swing lows on the market that I trade. Big swing rate, big range bar here. It was a kind of swing high, big range bar here. You get the idea. Is it perfect? No, you're going to get some false signals. You're going to get times when it kind of spikes and you might get involved, you might not. But it's a really good way of taming volatility and saying, hey, I will only get involved if I'm going to trade a reversal. I'm not going to try and catch a falling knife. I'm going to wait until I see the whites of its eye, the large, wide range bar, and then I'm going to consider. And then obviously you're going to structure your risk, you're going to structure all the other things that are key to the trade. It's only part of the story, right? But I think it helps loads because you kind of don't see it. If you don't have that, you kind of don't see it. These look very, very similar to the naked eye. But when you see it in relation to others, you go, wow, that sucker's massive. It's a 250-point bar in 5 minutes, right after a huge, huge move anyway. Okay, maybe it's time to look for a counter trend trade here. Okay, right. So next one is momentum magnet. And the way I like this, I love reverse engineering, having a target-based trade and reverse engineering it back to, hey, how can I frame that trade and get into the trade? Okay, so I would start with a high probability target. And for me, that could be a prior day high. It could be an overnight low. It could be an overnight high. It could be a gap fill. It could be any of these things. Okay, and it's up to you to kind of determine that. Sometimes it's a whole number. Right? You find momentum, you jump on that for a quick move. And the idea is that you have the magnet, You wait for momentum, you jump on. Now, this isn't going to be, it's not a hero trade. It's not as nice as these kind of reversal trades. But it's something that you can really get onto. And if you're ruthless with your stops on this, these can be very, very, very good. So let me give you an example. And there's going to be, you're going to have a big kind of mark, there's something here I don't like, and I'll address that. So let's say you had the Dow here. Let's say 40,000 is a significant level, and you had that as a magnet. You thought that actually 40,000 was a great place the price was going to go to. Yeah, you thought it's going to due to bounce to that. It's sucking its way back to that. Okay, so let me work back from there. Now you start to look at all the other things that might suggest that we could hit 40,000. Okay. Now the mistake I see many traders make is they say it's going to hit 40,000 and they just dive in and they don't structure the trade well. The key to this is to have that in your mind, the magnet you think the market is going to hit, overnight low, prior high, gap fill, key level, key support level, whatever it might be, and work back from that and say, okay, how can I take a small chunk of this move, but in a very high probability of success? High probability of success. Say a bit slower. You get the idea. So rather than saying, I think it's going to hit 40,000, buying it on a break here, having to sit through a 200-point pullback, probably getting stopped and getting all sloppy. Say, okay, listen, let me see. The context looks good. We've rallied hard. We've held with a little Wyckoff type spring here, pushed above high, closed above highs on that day. Great. Now the next day, I want to focus. It takes time to line up, but I'm going to focus. Maybe I'll take an opening range break. Maybe I'll take a break out the high. Bang. That's, to me, that's a high probability move. You've got your magnet. You've used it. Yeah, you might only be taking 150 points, 200 points, but it's, to me, this is you are adding the layers of edge together and together and together and waiting for your opportunity. The trade might be a very, very short time frame, or short duration, should I say. It's not quite as a hero as the guy who's buying here and saying it's going to go to 40,000, but you're trying to put the odds in your favor. And the momentum magnet trade is a trade that should work quickly. If it doesn't, you come out, and it should have a high win rate. It should have a high win rate. The risk reward ratio, fine, may not be as good, or nowhere near as good as a reversal trade, but it's a slightly different trade, it's a different setup. And that's just intraday zooming in. So you've taken days to see this. You've seen the high volatility. Maybe you've taken other stuff, but you're saying, you know what? I think it's going to be 40,000. You've added all this stuff up. Now you're focusing on the day on that opens. You say, let's take an opening range break, long, classical, structured trade to get in. You have your stop, you hit your target. The trade's over very, very quickly. Accept that. And maybe a 120-point trade. But to me, that's a really high probability of success, because the whole build-up has happened the days before, the whole structure of the trade, the price action, everything, and you're there, capturing this high probability opportunity. Great. Okay, great. Now, you might be saying, that's so much work waiting for a scalp. Yes, it is. But that's the difference, right? That's the difference, is that you say to yourself, hey, I think that's a great magnet. I think the market's going to go to that level. I think there's a really key chance it's going to go there. What's the highest probability way of doing that? And as a day trader, you want to be prepared for this type of stuff. And you see momentum, you say, I want to see all the things before it. Then I see momentum. I'm going to jump on. I'm going to take my high probability 100 points. Nothing's certain, of course. And obviously, you've got to have a risk management in place. But for me, that's adding a little bit more likelihood of success when I do it that way. And yes, sometimes you are waiting for a long period of time for a 15-minute period of trade. But that's what trading's about sometimes. Another example here, the cash weekend gap, right? So we had the gap lower. This was the Dow cash. We actually probably opened about here. That's a cash candle. Cash candles are a bit funky sometimes. You waited, and then maybe on the open here, you're buying this, or you're buying that first touch. And it's only 100 points or so compared to being the hero who bought down here, but it's a higher probability move. It's higher probability that the market might well fill that gap, and you're waiting for your opportunity. And yes, you only in the market for an hour or so, 15 minutes, whatever it is, but the whole structure of price has really helped build up the justification to take that trade. And notice, going off a side track here, you can check out a webinar I did about the Wyckoff spring, but very often we test the low on here. We fail to follow through, and that then creates the spring and the springboard for price to come back up and touch the highs. It's exactly the same as we had with the Dow here. We broke the prior low, couldn't find any sellers, and that was really the last kind of flush lower before we pushed back to highs. So something to watch out for. Okay, so let me run through some final little things here. Keeping some sort of performance review journal is key. We know this, right? It doesn't have to be comprehensive or massive. Just noting down what you've done, and especially in high volatile environments, it pays to be a little bit more focused. Just observe some of the things that's happened, especially if you're going to structure one of those magnet trades, right? You're going to say, hey, that looks likely, but not yet. Maybe tomorrow, maybe the day after. Let me just kind of have that in my mind and let me see how I could play that out. And this is how you play chess as a trader rather than drafts or checkers, depending on where you're from. You're thinking ahead, thinking, okay, well, if we do this and we fake out here and have momentum and open up strong, that's really going to set me up for that nice little chunk. Okay, well, I'll take that. But you don't know that unless you start to journal and start to track some of your charts and study those charts. What you're doing well, what you need to improve on, kind of goes without saying. One thing to also I think is very, very valuable is to mark up charts. So print off your chart or put them on a tablet, whatever it is, and just get a pen and paper rather than going to your screen and marking them up with the mouse. I think it's fine, but if you kind of struggle with that and you someone who likes to see it just physically there, print them off. Print them off, mark them up. What time did we reverse? Levels, key things. What could we do? Start to maybe hypothesize in different colors about the price action. Could we dip lower? Could we move higher? Be ready for a similar rhythm and flow the next day. Be ready for a volatility crush and expansion, and just kind of think, midterm, even if you're trading intraday. The other thing is to, really be prepared for high volatility. If you've got a checklist of what you're looking for, and what's your best trade idea? Am I focusing on one thing? Am I looking for a reversal today? You might go into the day saying, "Whoa, we're gap down massively in the morning, big range here. My job today is to try to find that exhaustion reversal point, and I'm going to look for that for a bounce back to VWAP or a bounce back to a moving average. That's my job done. I'm not going to try and overtrade this. That's what I'm looking for. So what do I want to see? I want to see persistency of trend. I want to see acceleration of trend. I want to see a wide range bar. I want to see it this time of day. You start to then frame out what you're looking for, and then maybe you say, actually, I can trade on the short side because I think we might take out that 5-day low that's looking there. There's going to be a lot of stops there. Okay, that's my momentum magnet trade. How do I structure that? And he was trying to think like that rather than just diving in. You can avoid those trap doors. You can structure your size, you can structure and then look for the trade that you want to take or the roadmap you've got over that day. Now, will that change? Can things change? Price action just change? Of course it can. You're there looking focused on a short, the market rips off the high side. Maybe you step back and go, okay, there's no short opportunity here. Will I still take the short if we come back and break the opening print? Maybe. Or do I want an hour line long? That's up to you as a trader. That's your job to kind of calibrate the conditions that are presented to you. The big one, the big trap door is that volatility crush. You just watch out for signs of contraction because that just kills so many kind of reasonably experienced traders. So watch out for the ATR just creeping lower on you. Maybe an inside day. News flow starts to dry up. You don't get the follow through as much as you normally do. That's a time, and I know it can be really seducing trading high volatility. Like, hey, I got all the opportunity. I love it so much because it's just what I live for as a trader. But you've got to be able to go, hey, listen, we've had an inside day now. Just let this play out because very often we have that volatility crush, calm the storm, eye the storm, and it will kick back into gear again. What you don't want is to kind of build your equity curve up during periods of high volatility and then give it all back again when the eye of the storm, and you've got to make it all back and you're actually back to where you were. You're much better to step back, say, hey, might be a break today. Put some level alerts in. If it breaks this, it breaks that, I might be interested. Otherwise, I'm going to leave it. I'm going to leave it to kind of let itself sort itself out. Learn to step back and to recalibrate. And that's one of the biggest, honestly, one of the biggest attributes of great traders is being able to do that. Whether we're talking intraday volatility crush, monthly, quarterly, yearly, just adapting to conditions is key. And the assumption that volatility will stay high forever. Maybe it does, but it will definitely go back and forth, back and forth, back and forth. Okay. And a final thing on this is to just be careful, right? Volatility amplifies your weak spots. If your discipline's not on point, if you're breaking rules, maybe your risk rules, your intraday kind of loss limits, your trade limits, just be careful, man, honestly, because volatility will just spot that and it will weed it right out. You must ensure that your discipline's on point. It doesn't take any prisoners, and you know this, and you've probably been a victim of this at a time or other in your trading career. Everybody has. If you haven't, be aware of it. You have to stick to your rules because the frequency of opportunities come up, it entices you to trade. And if you've been on a losing streak, then you've got the emotional attachment of I might make this money back. I'm frustrated. It's a bit of revenge in there, all that stuff. And then as soon as you start trading from an emotional bias or emotions are fueling your trades, then you're in trouble. So really, really work on your discipline. It's quite a good time to say actually that I've got this discipline tracker I had built for Google Sheets. You're very welcome to download it. It's absolutely complimentary to you. If you have it, great. Many of you do. But if you don't, you can get that from if you go to my website, tradersmastermind.com, and you scroll down or in the menu it says Trader Discipline Tracker. Just enter your email address and you get that. That will help you improve your discipline, and which is so, so key for high volatile environments. You just kind of track your discipline. You say, right, I'm going to try to become better at this. What's my benchmark for the month? Or I managed to do it 10 times this month. Well, next month, do for 15 and 20 and kind of say, right, I'm going to do this. It's going to take some time, but I want to ensure my discipline's on point. And if it's not on point, don't trade for high volatile environments. And you can grab that. It's really, really useful, that. Okay, so summary. We covered strategies for high volatility or rough strategies, broad approaches there, the exhaustion, momentum magnet. I like both of those, and maybe you can make something of those your own. Sizing and risk adjustments, we can attain volatility quite easily with position sizing. You focus on your risk allowance for the day. You work back from that. I want to risk X pounds per day, X dollars per day. How many trades am I expecting today? 5, 3, 10. How much is that per trade? What's that size going to be? And you might have to do some calculations on the fly to work out your position sizing, whatever instrument you're trading. The psychology of volatility, reframing it, volatility is not equal profit, it equals opportunity. I think that's a very, very distinct shift, and it helps you massively if you think of it like that. And if you go through a volatile period and don't make any money or don't make any trades, that's fine. Like the whole trading career doesn't rest on this one period of volatility. Performance review, important to up your game on that a little bit, and those trapdoors to avoid. Okay, so I'll take some questions now, ladies and gents, if you like, if you have any. If you don't, then we can call an evening there. Let me bring you over to the main screen. Okay. Oh, by the way, we've got some webinars. We were doing these weekly now, Tuesday, same time, same place. Make sure you are subscribed to either the Traders Mastermind email list. I'll send you information on that, or obviously if you're a Pepperstone client, and Pepperstone will help you out. If you're not a Pepperstone client, then you can jump on their email list and be notified when we do one of these. And the topic, and listen, you look at the topic and say, hey, I want to look at the topic, or I don't. That's fine. I guess not everything is going to be for everybody. I appreciate that. Okay. Let me scroll through some of these questions, ladies and gents. Gary Portugal says, great comment. The volatility does not always mean opportunity. Yeah, well, I think you mean profit, right? There's opportunity there, but you shouldn't. I know what you're saying here. You don't have to trade. You have to dive in, and that's the nemesis of so many traders. They see it swinging around, they have to dive in. No. There's opportunity there, but just be very careful and mindful and structured about how you trade it. Hence, the reversal type trade, the exhaustion trade. I want to look for a big range spike in bars. I'm not going to get involved in that. Or I've got a magnet. I want to get involved in that. That helps you really calm things down. And yes, Gary, wasting capital on mediocre opportunities, that is the big one for so many traders, not only in high volatile environments. You just do so well and you give it all back. And you do well, you give it all back. And then you run out of either desire to keep going or capital. And that's what tends to happen. I see traders do this. You do very, very well. You give it all back and then you get frustrated and you start hitting hard. You start taking trades you shouldn't do. You go on tilt, you give more back. And then you're kind of grinding back up over the months. And that cycle repeats, and it's very, very, very deadly to traders, that. And it all starts and stems from, starting to trade, risking capital on trades that are just so substandard, man. You wouldn't do it. You've got a negative expectancy. You're playing a negative expectancy game when you're trading in those substandard environments, those choppy, sloppy conditions. Sid says, other news release, what time is more volatile? From an intraday perspective, Sid, the open. So if you're trading the US session 2:30 UK time, DAX open 8 o'clock UK time, the close, and not so much the close, more spicy at the end of the month and the end of the week, end of the quarter, very spicy news, as you've said. But generally, there's news flow on the daily chart and there's something driving the market. I always look at what's the market's engine. There's an engine driving the market at any one time, and everyone's looking at that engine. And that could be engine, could be different. It varies. The moment it's inflation and the interest rates. What's he going to say about where the interest rates are going to go? Once we've solved that, so to speak, it'll be election. It will be this. It'll be something else. It'll be the price of oil. It'll be Japan a few weeks ago, right? So it's just understanding what is driving, what are traders looking at? Traders who have got big money to shift around the markets. What's driving their decision process, and then that will create a regime. And that market regime might last for a week, might last for a few days, might last for a few months, a few quarters, a few years, and then it will shift to something else. So that's the higher time frame regime that creates volatility. And intraday, you're always going to have the volatile periods during the open, during the close, at prior highs, at prior lows, all this type of stuff. Yeah, and Gary says not taking excessive number of trades. That's so important. You're absolutely spot on with that. Rob says, do the basis of strategies covered also work across higher timeframes? Yeah, absolutely, Rob. And I think that's a really good point, because what you're doing is you're saying, okay, that's my target, and that might take 4 or 5 days to get there, right? Example might have been DAX recently. You might say, I thought it was going back to all-time highs. How do I structure it from that? So I think you can still do that, and you just have to kind of recalibrate how you're going to get into the trade. And the exhaustion thing, yeah, absolutely too. You see exhaustion on higher time frames as well. But I think the real sweet spot comes if you're trading 2 or 3 day moves, which I kind of think you are, or even more. I know you've held trades even longer. You had a fantastic DAX trade not long ago. No, NASDAQ trade, I think it was. You can trade that intraday to get into the trade. If it stops you out intraday, fine, you move on. If you're in the trade and it closes and the market comes to a close in a position you're comfortable with, then you hold for a day 2 move, and then you kind of relax a little bit because you've got more of a cushion. Robert Francis says, looking at TradingView, added the ADR indicator, but I get the line chart rather than the bar chart. How do I get the bar version as shown in the webinar? Hey, I'll tell you exactly that, Mr. Francis. If you go to style and you change the style from where it says ADR, you got a color there. You go from line to histogram. So it looks like histogram. So style, and then you change it to histogram. That'll work. And you can thicken it up a little bit as well. Victor says, hi, Mark, great stuff. Thank you, Victor. Appreciate it. Does it make sense to change to a slightly higher time frame chart when the market's super volatile in order to decrease the nervousness? Yeah. Yeah, good point. Maybe I should include that, Victor. Good spot. Absolutely. It just kind of dampens down the movement, right? If you're there looking at a bloody 1 minute chart, your eyeballs going to pop out because it's like, yeah. So maybe you go back a time frame, or up a time frame, should I say, if you're normally a 1, maybe you go to a 3 or a 5, you're 5, you're 15, just to kind of give you an idea of where you're going to pull the trigger and where you might get interested in doing some business. And that does stop you maybe getting too excited about just nothings. And also, while I'm on that point, watch out for the auto scale on your chart. Don't know what charts everyone's using, but just be very, very careful, because if you let it auto calibrate you in 1 minute, you're like, man, that thing's going wild. Jesus, got 100 points, but actually it's just noise. When you scale back out and you put the high in, the low in, the open, you see a couple of days range and you go, this is just noise, man. But normally it looked quite big, so just be careful of that. Justin says, can you identify which ADR indicators the bar version on TradingView? Yeah, I think I've done that. Hopefully that's worked for you guys. If you just do ADR and then you select histogram, you'll get the bar. And I just love the bar. I think it's a great, great thing to really help visualize stuff. And then if you add the chart, you add to the pane below. I think if you right click on it, you can move it to the pane below. You'll figure that bit out. But yeah, the histogram is how you get the bar chart. Svante says, Svant, maybe I'm butchering your name, do apologize. Can you touch a little bit on the actual mechanics of the exhaustion move? For example, to the downside, large sell order, liquidity drying up, buyers stepping in, large bar. Yeah, good question. I love this type of stuff. I nerd out on this, so maybe people will switch off. But you are a nerd, fellow nerd too. Okay, this is how I look at this. I look at this like this. You have don't look at it like this is what's happening in kind of order book and order flow. Very often, as the market's getting lower and lower and lower, and the reason the market's moving lower and lower and lower, right? It's not there's more buyers and sellers because there have to be a seller for every buyer. It's the sellers are more aggressive. They're not getting filled. They're sitting on the offer. They're not getting filled, so they're hitting the bid. And then someone else is hitting the bid, and they're hitting the bid and hitting the new bid and new lows means that actually price is now going printing lower, printing lower, printing lower. And the quicker the move, right, the slower, the longer it takes for orders to step in on the bid. If the market's quiet, the order book thickens up. So talk about the futures order, which the CFDs are kind of based on. The order book thickens right up. And so it takes a lot for it to move. If the market's been accelerating to the downside and someone's been selling, those buyers are not replenishing quickly. And so what happens is it gets quicker and quicker and quicker and quicker. There's not much liquidity on the buy side because no one's had a chance to put the orders in because it's moved so much. And it's moved more than normal. So the order book is very, very thin. Now someone comes in and goes, get me the hell out of here. Bang, slams a market order into the market. A large sell order hits the market, or a large wave of a couple of sellers hit the market. Boom, we shut it down massively. And at that point, we've kind of gone so much so quick that there is a buyer just goes, boom, steps in there and just holds that order. And what also happens there is we held that there, and very often it's a really slight pause. And because we've moved down so quick as well, there's now a liquidity vacuum on the order book to the high side. So all those sells, someone's come in and swept like 10 levels of order book. There's now few contracts there. And so that's why we often get the snap back so quickly, because there's a liquidity vacuum there as well. So liquidity dries up on the downside as we kind of accelerate and quick, and liquidity is almost non-existent when we've done a big flush. That's why it's so easy for it to pop back, and why I consider it a reasonably high probability opportunity, because you do have that kind of the selling's done. And also if we step back one layer, once that selling's done and the overhang of supply has gone, you've now got just demand coming in. Very often, one point here is very often you do get demand that pushes it back up to a mean, and you get a resumption of selling in the evening or the afternoon, whatever you're trading. Fine, that's a different thing, but that happens quite a lot. Anthony says volatility brings out your weaknesses. This is such a great thing to remember, even for a moderately seasoned traders. Yeah, right, Anthony. It can do, and it does. And I just come into the markets when it's highly volatile, and I say to myself, "Listen, man, just be careful. Whatever you think you are, whatever you've done before, the market will humble you in an instant if you're not careful." And we can put circuit breakers in place. We can put different things in place that we've talked about on the Traders Mastermind calls. We reduce our account balance. We don't need to have massive amounts in there. Just need the amount required to do the business we want to do. But just a reminder, it just takes one moment of weakness, one slip up, to do a lot of damage. And it's just you don't have to go crazy about it in an experienced trader, but you do have to just remind yourself, hey, I've got a lethal weapon here. The mouse is a lethal weapon. I need to be very, very mindful about how I deploy this, because if I'm not careful, I could do some damage I don't want to do. And it's just reminding yourself, it's not operating out of fear. It's just operating out of a point of responsibility. You've got capital to deploy. You're responsible custodian of that capital, and you're a risk manager. So, yeah, very good point. Okay, ladies and gents, thank you so much for attending. I hope you've enjoyed this one. Market's just been chugging down as we've been talking. So maybe there's a couple of hours trading left for you. If you are trading, please keep your risk managed, and I shall see you again next week. Take care. Thank you so much. Bye-bye.